Unfortunately, the U.S. debt ceiling is making headlines on a daily basis. The drop dead date laid out by Treasury Secretary Janet Yellen is quickly approaching of June 1st. Now, that date is not set in stone. There could be some potential wiggle room where we could make it until mid-June, maybe a little bit later, depending on how revenues are going out the door and how tax receipts are being received. But it's clear that there is an urgent need to raise or suspend the debt ceiling. Most of the headlines are around the June 1st drop dead date that Yellen has laid out. And if the debt ceiling is not either suspended or raised by then, there's a big concern about the U.S. defaulting. In our view, the risk of a default is not on June 1st or June 2nd, but it comes more into July. Because fortunately, for the first time when you're talking about the debt ceiling, there's a little bit of luck on the Treasury side, because the first big debt payment, interest payment of roughly $2 billion occurs on June 15th. And that's going to come at a time when the Treasury Department will see a big inflow of tax receipts from corporations and individuals. Therefore, while the immediate threat of a default is not there, it doesn't mean the economic costs of not raising or suspending the debt ceiling are not enormous. As you can see, there's roughly about $290 billion in payments that the federal government has to make in the first 2 weeks of June. These payments go out to certain things like Social Security, welfare, and if any of these or some of these are not made, that will have an economic cost, and that cost escalates the more and more these payments are missed. Therefore, time is of the essence. The debt ceiling needs to be raised or suspended, or the economic costs intensify rapidly.